All right, everybody. I'm just going to go over two opportunities that set up straightforward. One was in gold and the other was in the ES. So in the gold market, you can see that price is clearly going down, 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 down until this here. So this, typically I wanted to break out and make a higher high, but when I saw this, I looked at the volumes, and it was only the biggest volume in past 4 waves. So that's not that great. But this right here was meaningful. You can see how it broke above these this white line. So it's clearly above the average, significantly above the average, and it's 1.7 times the average, so 70% more volume. That's all right. That means there's buying activity. Right? So when it went down here, it was bought up. So that's one little indication. And then after that, when it pulled back, the supply is less. It's actually less than average. So something's brewing, right? You can see that the supply volumes started diminishing after this selling wave. Yeah, this one was average. This one is average. It's not really above average. This one is less than average, and before that you have high volume activity. So, these were some indications. Now, that really wasn't enough for me. I wanted to see if there was any more indications, because I just want even more clarity about the supply-demand dynamics. So when I went here, right, and started looking at gold, what you saw, the selling, here, there's something going on here. 1,100 contracts and another 1,100 contracts, and then this break, sharp. At first it looks really bearish, right? But you're going to notice that the break was used to establish a position right there. This break went all the way down, but the heaviest volumes are at the low. Why? Because someone is using this weakness to get long. Now that's still not enough. What made me more bullish was what happened right afterwards. A lot, when you have a volume at the end, it could also be some type of covering, right? So they're just using it to cover. But the response right there, this is not normal. All right, this is not normal. For example, in the prior responses, right, you have a red bar, you have volume at the end, and the response is little. Here you have a red bar, volume at the lows, right at the end, or at the lows right here, right here. The response is garbage. But this time, as the red bar finished, there's high volume at the bottom with a very good buying response. So that totally changes the game, because it means that there's follow-through buying. There's follow-through buying, right? The bar before it shows high selling volume with no follow-through. So whoever took the other side buying the 1,300 contracts did follow through on the upside, such that it was a big bar and had follow through buying, 2,100, 2,000, and 1,800. So no follow through here, and high follow through, strong reversal here. So buyers are buying, and that's why you see this big wave. So there's buying activity. Now, we don't know if it's going to sustain, if it's going to this or that or whatever, until these multiple down waves. These multiple down waves, 29, 26, and 9. No supply. No supply. Zilch. Nothing. And then after that, the conditions of no supply allow buying activity to create this bar. Because there's no supply, it's easy to go up. Ease of movement, the ease part in ease of movement is the result of no overhead supply. So when you have 29, 26, and 9, it shows that supply is diminishing, and that creates the condition for ease of movement to the upside, creating your big green bar. Because there's no supply, so it's easy to go up. And that initiated this rally. Now, I don't know what's going to happen now. Don't really care. It's done. This leg, the trend right here on this time frame is up, but this leg seems like it's terminating against that prior high, that red bar there. So we'll see how it plays out. In my opinion, right here, there's a lot of volume, so it can pull back to this near this support, like that 29, 21, around there. So don't really want to hold. All right. So what are the key lessons here? First is, in a downtrend, you have big volume coming in. Big volume by itself means nothing. It can just be covering, and it can be sold. It could just be a relief bounce that it's covering, and then just sell it, and it'll break down. But you have that big volume, and the pullback shows they're not selling the bounce because the volume is less. It's not only less than the prior wave, but it's less in terms of less than the average selling. The second thing here is that the trend of the supply is decreasing. You have 29, 26, 9. So the trend is decreasing as the numbers are decreasing from 29, 26, 9. The third thing is you have your springboard or bearish springboard or whatever, LPS, right here, where it's totally gone. The supply is totally diminished. And that lack of supply creates the condition for ease of movement to the upside. And that's why you have this green bar. So these are three major things. And then from the tape reading chart, which I taught you guys in the last video how to read, right? You have big red, you have high volume, no follow through. That's part of what to look for. High volume, no follow through, because it means that demand is meeting that supply. So you have this supply, no follow through, because demand is meeting that supply, absorbing it, buying it, and then demand continues to buy, and the evidence of that is that big green bar to the upside that takes out the red bar. So supply meets the demand, and demand follows through where supply doesn't, helping to shift the direction. After that, you have some test, and there's some reaccumulation here. Right? We got 1,900 contracts. You want to see what happens after that. It's a green bar. So the buyers met Demand met supply here and proved itself with this thrust on the bar chart. You want to see what price does after, supply meets demand or demand meets supply, to show you that, who is more in control or more aggressive, etc. Okay, so we're done with this. Let's go to the ES. For the ES, it's going down, 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 down. First evidence is right here, biggest volume in 18 waves. Okay, but again, I'm not a fan of big volume without price movement, because it could be covering, it could be whatever. You want to see big volume and a higher high breaking out, and that's what happened here. So yeah, that big volume, you see that significantly above average. Is 1 point. Actually, it's 2 times average volume. Average upwave volume. This is 2 times average upwave volume. It's 200%. Twice as much as average up volume, and the biggest in 20 upwaves. There's more volume in this upwave than 20 prior upwaves. You think that's not important? Obviously it's important. Someone's buying the low, right? So someone's buying the low because they're getting low good prices. So they bought 38,000 contracts. So that in itself is very critical information, but now you have to see if supply is there or not. On the first pullback, look at this. Look at this. Look at this. Does that look like supply to you? Does that look like, oh yeah, we're going to sell off this rally? Does that look like strong? Does that look like strength in supply? Obviously not. That's not supply. That means that supply got exhausted here on the prior downwave. All right, and then after that you have that green bar reversal. Now here's the thing: in a lot of markets, what happens is there's a manipulative maneuver right after this. Okay, it happens all the time. Every market, there's like what you call a shakeout. All right, so if you understand that, this maneuver here, this is a type of shakeout called a spring that takes these lows. So this I view as some type of shakeout, spring, manipulation, whatever you want to call it. And that's fine. You just have to anticipate that before big moves, there's typically a lot of times there's a shakeout. So how that shakeout manifests is just a big wave, right? And it also has a lot of volume because it's running the stops. It's a lot of all of that. So the first pullback gave us our clean indication that you had high volume buying and a low volume pullback, where the high volume is the biggest up volume in 20 up waves, and the pullback is only 70% of average down volume. All right, that's 30% less than average. And then what happens is you have a shakeout. Now, what's critical is what happens right after the shakeout, and that's a big green bar. Right there, big green bar. So that's really important. That means I'm right that this is a shakeout. Because if this was a breakdown, it wouldn't be a big green bar. It would be a big red bar breaking down below this low. It would be a breakdown bar, right? But why is it going in the other direction back up? You see? Means that there's buying activity overcoming the selling activity. And this is a pretty big thrust. The range is quite big. So this establishes the reversal, and they go right back up. Now we'll take a look at tapering chart. Tapering chart was very clear right here. It showed that the price as it's going down, maybe there's some accumulation here, 21,000 contracts, dip and reverse, and prices marked up. This type of volume that is not near the lows but at the prior bar highs, this is the breakout volume. Remember I explained accumulation volume, breakout volume, and distribution volume. Right, so this is the breakout volume that's breaking these highs. Bang, bang, bang. 9,000 contracts, 12,000 contracts breaking this high. As they break the highs and breakout absorption volume comes in because they're taking them out, right? And after that, you had this move down here. What happens? Pull back, 9,000 contracts and 19,000 contracts trying to take these lows. Do they have follow through? Barely. Barely. So as they come down, you have 9,000 and then you have 19,000. That's very significant. And the volumes get high because they're trying to break these levels and shake out or stop run, right? What happens afterwards is reversals. It's not very apparent, like a stronger reversal here, a bigger green bar, but it's enough where you have to make a judgment, and this green bar on the bar chart or wave chart is what's telling, right? Here it just shows that it doesn't have much fall through because of the immediate green reversal, right? And the fact that the volumes are near the lows. Like the 19,000, does it have a lot of follow through or does it reverse? It has very little follow through and it reverses. Again, I would have liked if it was a big green bar, but they just, sometimes not that clear. And the big green bar comes here. See that? And in it, you have the breakout volume right here. This is breakout volume. Why? Because it's across the highs. So it's breaking the highs, therefore it's breakout volume because it's breaking through the highs. And it does have follow through of 1, 2, 3 boxes. After that, there's no question that this is them doing the stop run or accumulation of the lows, all of that. And then the price goes up. And at this point, after this markup of prices would mean that this 14,000 contracts was reaccumulation on the pullback, leading to markup of prices, and that 20,000 is your breakout volume. This 18,000 is some type of profit taking, some type of selling. Maybe they buy low, sell some high, and as it started dipping back, 14,000 came in. You don't know that it's a reaccumulation volume until the markup of prices right here, which makes this area a support area. Accumulation is an accumulation support. It's a volume-based support. So prices until you have distribution volume that breaks the lows and all of that, this is still bullish. All right, I've done enough. Take care, guys. Bye.